You're listening to Capital Topics, episode number 74. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In our podcast today, we'll discuss the current volatility in the stock market and then revisit the state of the ETF landscape in Canada, as well as the debate between active and passive funds. Enjoy! Hello, James. How are you today?
I'm very good, François, and how are you?
I'm very good, thank you. So before we tackle our main topic today, we believe it is important to address the current market volatility triggered by American tariffs imposed on the global economy. James, what do you want to share with listeners?
Well, these are certainly, how can we say them? Chaotic times. François, it's really at times like this that most investors get to know their true tolerance to risk when they're faced with real downside financial market volatility.
Mm-hmm. Yeah.
But one fact remains: when you have a long-term investor mindset, short-term macroeconomic events should not change your long-term investment plan. What investors need to keep in mind is that you have no control over the markets, but you do have control over your emotions.
Yeah, correct. We've said that many times. You can't predict human behavior, but you can control your own emotions. We have also said many times on our podcast, it's simple but not easy to do. What you need to do is tune out the noise.
Okay, so it's at times like this, François, that it's useful to review some of Warren Buffett's famous quotes about investing. And we often say everybody talks about him, but very few people really listen to him and follow what he says.
Well, there's a great one for this context, James. And he once said, stocks are safe for the long run, and they're very unsafe for tomorrow.
Well, François, I'd like to share with our listeners something I read recently in my LinkedIn network. This was published by an American investment thought leader. He highlighted that there are three different types of investors in volatile markets. The first one is headline reactors who follow the noise of the financial press and generally buy high and sell low. Their greatest disadvantage isn't information, but what information to ignore. The second are paralysis victims. Basically, they're frozen by uncertainty. They miss out on taking advantage of cheaper prices in the markets. They don't invest or they don't rebalance their portfolio to their long-term investment plan. They are waiting for, quote, the right time to buy when it seems safer.
Right.
The third, much smaller group are strategic operators like Warren Buffett, who you just quoted, François, and they really understand this is when fortunes are made. They tune out the noise and manage their emotions, sticking to their long-term investment plan.
Yeah, James, if you have a well thought out long-term investment plan, what's best for investors in times of uncertainty like we're living through right now is to stick with it. Now, let's get to our main topic of today. We'll give our audience an update on the ETF landscape here in Canada and on the worldwide usage of passively managed retail funds. In addition, we will also review, as we have done in the past, the Morningstar Active versus Passive Barometer for the US and the SPIVA Canada Scorecard from S&P Dow Jones Indices. Both of these reports measure the rate of success of active management compared to their passive alternatives.
Well, there's a lot to cover, François, so where would you like to start?
Well, James, I'll start with an update on the ETF landscape in Canada and make our way to the other topics after.
Okay, so great. Let's jump right into it.
So as I believe most of our listeners know, the popularity and growth of ETF has been extraordinary in the last couple of years. According to National Bank Financial Markets, assets in Canadian-listed ETFs at year-end 2024 have now surpassed the $500 billion mark to reach $519 billion of assets under management. This represents an annualized growth rate of 21% over the last 10 years.
Wow, that's really impressive, François. The industry has grown tremendously from when we first started using ETFs at PWL back in the early 80s of 2001, 2002. And back then, I think there were only 2 ETF providers in Canada with only a handful of listed ETFs on the stock exchange. So where is the ETF industry at now, François?
Well, James, believe it or not, there are now 1,497 ETFs listed in Canada. That's more than the total number of stocks listed in Canada. And there are 45 ETF providers. In 2024, only 224 ETFs were launched, and Canadian ETFs gathered $76 billion in assets, a record year in terms of inflow.
François, the last time we reviewed this topic for our listeners, I believe you had mentioned that a high percentage of the newly launched ETFs were actively managed ETFs. Is that still the case?
Well, James, indeed, the total number of passive ETF hasn't changed much since 2021, but in the last 5 years, an average of 119 active ETFs were launched every year in Canada. They now represent more than half, 53% of all Canadian ETFs listed. And in terms of assets under management, they now have gathered $161 billion, which represents 31% of total assets in Canadian ETFs. That's up from 25% in 2021.
That statistic is really an eye-opener for me, François. I don't think that the growth of active ETFs is good news for Canadian investors. I recently came across an article from Morningstar entitled 15 Funds That Have Lost the Most Value for Shareholders Over the Past Decade. And this article makes it pretty clear that some types of ETFs are real wealth destroyers for investors.
Yeah, James, I read that article as well. And out of the 15 funds that have destroyed the most wealth for shareholders or investors over the last 10 years, 13 of them were ETFs. These are not your plain vanilla total market ETFs, but the more specialized ones, the ones that invite investor to trade, to speculate. In that list, there are leverage ETF, inverse ETF, but also active ETF. In the active category, the once high-flying ARK ETF. I don't know if you remember those, James, but
Kathy Wood.
Yes. And they made the headlines and attracted huge inflows in 2020 and 2021. And they are now it's now the fund family that has destroyed the most wealth in the past 10 years for investor at an estimated $13.4 billion of wealth destroyed.
That's just mind-boggling. Well, I guess, François, some investors will never learn. Investors are reacting to past performance, which is often random, but in the end, they just get burned. As Morningstar puts it, and I quote, volatile and speculative categories, as well as fund companies and active managers that attract a lot of short-term hype, are best avoided.
Yeah, correct. I could not agree more. There's another quote in the article that summarizes our view, and I quote, ETFs have many things going for them, including low cost, tax efficiency, and typically a passive investment approach that makes them suitable building blocks for diversified portfolios. But they can have a dark side. For instance, some ETFs focus on narrowly defined sectors or themes, which can make them harder for investors to use successfully and can attract speculators. The good news, however, and I'm referring back to the National Bank Financial Markets Report that I highlighted earlier, is that low-cost index tracking market cap-weighted ETF still dominate inflows of funds in Canada with $29 billion in 2024 out of the $76 billion I mentioned earlier.
That's exactly right, François. That's really good news, and it's in line with the latest report from our good friend and colleague Raymond Carzero, who highlighted in his report entitled The Passive versus Active Fund Monitor that passive funds dominated capital inflows and increased their market share not only in Canada but around the world last year.
Yeah, correct, James. According to his report, passive funds attracted more new money than active funds in Canada, the US, and the rest of the world. Passive funds in Canada now have a market share of close to 20%. In the US, that market share has now surpassed the 50% mark and is currently at 53%. And in the rest of the world, the passive shares has now reached 30%. Globally, passively managed funds have increased their market share steadily since 2015, and they now sit at 43%. Passive funds in the last 10 years have attracted $8.7 trillion US dollars, while active funds saw outflows of $839 billion.
Well, what's clear from those statistics, François, is that passive dominates active in terms of new funds invested. However, Raymond in his latest report cautions against drawing the simplistic conclusion that 43% of the market is passively managed. So here's a quote from his report we'll share with our listeners. Even portfolios holding truly passive funds are often managed with an active approach based on tactical views. Plenty of individual investors and financial advisors can't resist the temptation of market timing, no matter how flawed this activity may be. Holding passive funds does not make in and of itself a passive investor. End quote.
Yeah, well, James, we've mentioned this several times before, and I refer back to our podcast number 68 when we touched on this topic when we reviewed the Morningstar 2024 Mind the Gap report, a report we may review again this year later.
Well, François, I think our listeners know that we're not fans of market timing and active management, and I think the latest Morningstar active versus passive barometer for the U.S. and the SPIVA Canada scorecard from S&P Dow Jones Indices support our view that holding passively managed funds with a buy and hold investor mindset is really the way to go to be a successful investor.
Yeah, exact. And the results are quite compelling again this year. Looking at the SPIVA Canada report, which measures the performance of actively managed funds against respective benchmark or indices, 2024 was yet another difficult year for active management in Canada.
Indeed, François, across all fund categories covered by the report, an average of over 80% of actively managed funds underperformed their benchmarks last year. For international equity funds, they had the lowest one-year underperformance with close to 72% of them trailing their benchmark, and the dividend and income equity funds were the worst with almost 96% of them underperforming.
I'm always shocked when I see these levels of underperformance, especially when we know that underperformance rates are generally higher as time horizon increases.
François, to that point, over the last 10 years, an average of 93% of active funds underperformed their benchmarks. The best performing fund category was Canadian small and mid cap, with 82% of managers underperforming their benchmark. And the worst was Canadian focused equity funds, with 100% of active funds underperforming. So what a terrible record.
Yeah, 100%. Well, to be fair, James, for active managers here, when we review the performance of active funds against benchmarks, we must acknowledge that those benchmark or indices are not investable without incurring any fees.
Well, that's totally fair for you to say that, François, so I agree with you there. However, the underperformances in some fund categories can't simply be explained away by the differential in fees. For example, funds benchmarked against the S&P TSX Composite Index for Canada underperformed by 4 percentage points the index last year, and funds benchmarked to the S&P World Index underperformed by 9 percentage points the index. The active managers in the S&P World Index category therefore left a third of the performance on the table last year since the benchmark gained 30%.
Wow, that's terrible. How are these poor results explained, Jane?
Well, the SPIVA report highlights that since a minority of stocks drove most of the gains and that fewer than half of the constituents beat their benchmark in all fund categories last year, poor stock selection by active managers is to blame. They simply didn't own a sufficient weighting in those high-performing stocks.
Yeah, that's the same reason as last year. If you don't have the right stocks in your portfolio, you will underperform the indices. Our listeners need to remember, over the long run, only a small percentage of stocks generate most of the returns in the equity markets.
So now let's look at the results for the U.S. And for this, François, our listeners should know we use the Morningstar U.S. Active versus Passive Barometer. The Morningstar methodology is different from the S&P SPIVA reports. Morningstar measures active fund performance against their respective passive peers, net of fees. So this, I think we can say, is a more fair comparison.
I agree. The results from the Morningstar report demonstrate once again that active mutual funds and ETFs underperformed their passive peers last year. Like in 2023, the average success rate of active manager was only 47%. This means that throughout the 20 different fund categories, on average, only 47% of active managers were able to beat their passive peers. Over 10 years, less than 22% of active strategies survive and beat their passive peers. Also, as in prior reports, if you increase the time horizon to 15 or 20 years, the success rate of active managers drops even further. The only silver lining I see here for investors that still want to believe that active management is better than passive is to select funds in the cheapest quintile, since their rate of success is 11 percentage points higher than for the priciest funds. The success rate after 10 years remains nonetheless very low at 28%.
When you say cheapest, you mean cheapest fees, lowest fees versus higher fees.
Correct.
So, François, I think this about covers what we wanted to talk about today. To conclude, I will quote from our colleague Raymond Carzaro's report. Passive funds offer advantages that active funds can hardly compete with, including lower management fees, lower transaction costs, consistently higher returns, transparency, tax efficiency, and peace of mind for investors.
I totally agree with that. And on this, we'll conclude. Thank you, James, for sharing your thoughts and expertise today.
My pleasure, François.
So that's it for episode number 74 of Capital Topics. Don't forget, if you'd like to submit a question or a suggestion for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your assets, you can reach us by clicking on the contact button, which is located on top Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share it with your family and friends. If you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on May 14th. In the meantime, make sure to consult the Capital Topics website for our latest blogs. See you soon.